Hello everyone, welcome back to the Ameriwealth Talk Show. I'm your host Karan Murugesu. This is episode number 5. Thank you so much for being here, and as always, thank you for your questions, the messages, and the feedback you continue to share with us. And today we have an exciting guest. I have Mr. Enrique Uriquara, who is our Chief Operating Officer at Ameriwealth Financial Group, and he joined us for this conversation. Enrique, welcome to the Ameriwealth Talk Show, and I'm so excited and happy to have you on this conversation today.
Thank you, Karen. I'm very excited to be here. I've been watching your videos, and I'm really excited to be a part of this one. So thank you again for inviting me. I'm really looking forward to it.
I'm glad you are here.
So yeah, I'm very excited that we're going to cover a very important topic today, because I know in the last episode you covered a lot about the various retirement plans, all the different type of accounts, but also the actual strategies for contributions, right?
That's right.
And investment strategies. But you really said that you were going to dedicate an entire episode to actually the distribution. Right?
Absolutely. Distribution is as important as putting money into the plans. That's why, I want to dedicate this entire episode to talk about it, because there's a lot of information. So we wanted to cover many types of retirement accounts, right? Like we wanted to include IRAs, 401k. There are some people putting money into 403b plans, and some of the people who are working for governments, they participate using 457 plans, and there are some Roth accounts, right? So we want to talk about what will happen when the money comes out of a retirement account. Will there be any taxes? Will there be any penalties when you take the money out from the account? And there are many ways we can use this information to educate you. Our purpose is to provide information that will help you make some smart financial decisions. We work with a lot of people, but we don't have the privilege to work with everyone. But we want to spread the information to as many as people possible so that somebody can benefit from the information. That's the goal for this episode.
Yeah, no, I think it makes a lot of sense. We've talked about this. It's actually interesting that you hear about all these people who are now climbing Mount Everest. There's a tremendous interest, but when you hear about that, you think, oh my goodness, to climb that is so dangerous. But the interesting part is that it's actually more dangerous coming down, right? And so it reminds me of how important it is for us to have strategies for when we take the money out, not just the contribution strategy. Right. So I think this is really a really valuable segment.
This episode is for educational purposes only. So if any of the information we discussed today spark your interest, before you take action, please check in with your tax professional and financial advisors so that you can do the right thing for you. Because one size doesn't fit all, and taxes are one place where you don't want to make any mistake and any surprises later. So with that being said, let's discuss about some of the distribution strategies.
Yeah, that sounds terrific. And I think we should start with the basics, right? When we talk about distribution, it's essentially just withdrawals, right? Isn't that basically what it is?
That's true. Sometimes IRAs refers to withdrawal, distributions, but all are same. So we might be also interchanging the word distribution and withdrawal, but for our purpose, it's all the same.
Okay, great. That makes sense.
The IRS really pays attention when the money comes out of a retirement account. That's when you will see all this terminology and the consequences come into play.
Yeah.
So when it comes to withdrawals, taking money out of your retirement account, there are two questions come into play. One, at what age you are taking the distribution. And the second is what type of account that you are taking the distribution from.
So there's a difference depending on the type of account?
Absolutely. Okay. It will change based on the account that you are taking the money out of. And also there's one more age that you are going to continue to hear again and again, which is age 15 and a half. Enrique, we are talking about taxes and penalties, right? But one thing I want to be clear. Taxes and penalties are not the same thing. In some situations, the distribution will be taxed, but there won't be any penalties. But in some situation, the distribution you take may subject to taxes and penalties. And in some situations, you don't pay either taxes or penalties, right? But as soon as you understand the difference between taxes and penalties, a lot of confusion might go away.
Yeah. Well, I think it was helpful to understand that the two things that really drive whether or not you get taxed and how much and what the penalties are, if there are any, the age when you're taking out the money, and you said the type of account.
Correct.
So maybe we should start with probably one of the more popular kinds of retirement accounts, a traditional or pre-tax IRA. Can we do that?
That's great because many people are familiar with IRAs. We said pre-tax IRA. That means your contributions going into the IRA before paying the taxes. So you are telling the IRS that, hey, I will pay your share, your taxes in the future, right? That comes with when you are taking the distribution. The distributions are considered as your ordinary income.
Got it.
Remember we were talking about age 15 and a half, right?
Yeah.
So age 15 and a half comes to play on traditional IRA when you take the money out too soon before you turn 15 and a half. So what happens when you take money before the age of 15 and a half, you will end up paying extra 10% additional charges to take the money out too soon.
That's the penalty.
That's the penalty. So we call that early withdrawal penalty.
Got it. Now, is that always the case or are there some exceptions to that?
That's a very good question, Enrique. If you know there are exceptions to that 10% extra penalty, right? If you know that information, instead of just going out and taking the money out, you may consider maybe using some of the exception to avoid that 10% penalty. But before I get into, there are some exceptions. IRS allows you to take money out of your IRA without having you pay 10% penalty. But you wanted to be clear. Even though you are going ahead and taking the exception, but it will not help you avoid paying the income taxes because the taxes are always there.
Yeah.
Okay.
Uncle Sam always gets his.
That is correct. Because that's the partnership you are creating, right? You're telling, hey, help me out, pay less in taxes now, and down the road I will pay the taxes. Let's talk about the most common exception IRS allows you to avoid that 10% penalty, right? Most commonly, people use IRA to maybe pay for some higher education expenses, right? The IRS help you out, pay for some higher education expenses, and as long as the money is going to the education institution directly, the IRS might help you to save that money. Also, if you are using the money to pay for any medical expenses, right? Medical bills, some of the, largest bill that you receive in certain situations. So IRS wants to make sure, you are not penalized because of using the money to send to a hospital. The third thing we can consider, if you are taking the distribution because of a disability, right? If you become disabled and you are unable to continue doing what you are doing, right? In that situation, IRS may say, hey, we need to help you out here. You don't have to pay us the 10% penalty. But remember, you will have to pay the...
I think that helps. I mean, those are really tough situations, I think, in each case. But what about something more positive? What about if you wanted to buy your house, a first-time home buyer? Do they have an exception for them or no?
There is an exception. IRS allows you to take up to $10,000 for your first-time home purchase. It has to be a primary residence, but IRS does allow you to do that as well. It's a great thing that you asked.
Okay. It's just for the first time,
First time, yes.
Got it.
And primary residence, yes.
All right, $10,000, first-time home buyers. We hear a lot about young people who are struggling, but I think at least having 10,000 that they're not going to be penalized on could help with the down payment. So I think that's really helpful.
Yeah, I hope so.
Okay, so that works. And any other exceptions that come to mind?
There is one not many people are aware of, which is called the substantially equal periodic payments. It's also referred to 72T. So what happens there's a formula set by IRS, and the formula says in order for you to avoid that extra 10% penalty, you need to take certain amount of income every year on a periodic basis. So as long as you are satisfying the requirement, you will not pay the extra 10% penalty, right? If you are in the plan and you cannot break the contract, if you break the contract and all the taxes and penalty will come back into the play.
Okay.
So you need to be very careful. And if you are thinking of doing this, you want to make sure you check in with your tax professional before you even start anything. So
yeah, it just takes a little extra planning and make sure you have the right people looking at it.
Absolutely.
So I know many of our clients are small business owners, and sometimes I find that, they tend to have simple IRAs.
That's correct.
Do the same rules apply for simple IRAs as they do with traditional IRAs?
I'm glad you brought it up, right? Simple IRAs work slightly differently. When it comes to simple IRA, the main difference here, right? Like within the first 2 years of the contribution into a simple IRA, if you make a withdrawal when you are under 15 and a half, the penalties are slightly higher than traditional IRA penalties. We are talking about 10% penalty on a traditional IRA, right? On a simple IRA, it is all the way up to 25% in the first 2 years.
25%?
That's correct. Many people do not really understand that. because it's usually provided through their employer. They started putting money into it, but it is something you have to make sure you understand ahead of time.
Wow.
The 2 years period starts when you start participating into the simple plan. And remember, we talked about some exceptions for avoiding the 10% penalty. But in case of simple IRA, none of those exceptions actually work. So in the first 2 years, those exceptions will not come into play, and you are not going to get a way out of simple IRA early withdrawal penalty within the 2 years.
Ouch.
Yeah, that's a big one.
All right, that all makes sense. Maybe we could go next to like 401k plans, 403b plans. Those are where I think most people are.
Using
Yeah,
from the employers, correct.
Yeah,
that's great, because most of the time when it comes to 401k or 403b plans, people are just doing it automatically, because that's one of the things being told by the HR. Hey, you have a 401k, you have a 403b. But it's important that you understand how taxation works on your retirement benefits. So when it comes to 401k or 403b plans, depending on where you're working, you will have different plans, right? We talked about it before. And also there are some people will have 457 plans, right? If you're working for a government. But the taxation works quite the same. If you look at it, the money comes out of it will be treated as ordinary income. And if you are taking the withdrawal before the age 59 and a half, usually just like your traditional IRA early withdrawal penalty, there will be additional 10% of penalty there.
right. Okay, so before with the traditional IRAs, we talked about exceptions.
Correct.
Are there similar exceptions for the 401k and 403b plans?
One of the very helpful exceptions I can think of is the rule of 55. If you are working for an employer and they provide 401k, for an example, right? And if you are leaving the employer at the age of 55 or later, or the employer letting you go at the age of 55 or later, you can literally take distribution from that plan, specifically from that plan, and without having to pay the extra 10% penalty. But remember, waiving the penalty is not going to avoid you the taxes. You still have to pay the taxes, right? But again, sometimes people think of rule of 55. They connect that with 401ks only. But it can also work with 403bs, but if the employer allows that.
Oh, interesting. But I like that because, at least if you're over 55, but not yet 59 and a half, you won't get penalized if your company lets you go.
Yes, and you should remember one thing, right? If you are thinking of moving the money into an IRA, right, you got to be very careful. The moment you move this money into an IRA, you are going to lose the benefit of rule of 55. If you are leaving an employer and planning on consolidating your retirement accounts, just make sure you are aware of this exception so that you will make an educated choice for your retirement savings.
Oh, that's very helpful. So, Karan, I want to ask you something because in the past I've worked for large corporations and, just like many of our clients, they sometimes will receive company stock as part of and is included in their retirement savings account. Is that treated differently?
That's right, Enrique. That works slightly differently than traditional 401k distributions. And when you have employer stock inside your 401k, there are also special tax treatment that you need to be aware of, which is called a net unrealized appreciation. People also call it as NUAs. Those NUAs tax as capital gain rather than ordinary income. If you do have employer stock in your 401k, please make sure you know how it works and how it's vested in your 401k.
Okay, so we've talked about traditional IRAs. We talked about 401ks, 403bs. You mentioned 457 plans. And can you talk if that's different at all?
457 plans usually offered for government employees, right? So when you're working for government, you might be part of their 457 plan. And the distribution generally taxes ordinary income. But there's a difference in early withdrawal penalty. On traditional retirement account, there's a 10% early withdrawal penalty while you're working, or if you are separating from the services, there are possibly a 10% penalty too, right? But when it comes to the 457 plans, there is no 10% penalty if you are separated from the services. That is entirely different than the rule of 55.
Yeah, that I was going to ask that. So it's different from the rule of 55, which says that if you're between age 55 and 59 and a half, and you leave your employer, then you won't get taxed that penalty.
Correct.
But here, you don't have to be. You can be even under 55?
Under 15 and a half, as long as you are separated from the services, there's no 10% penalty. That's the beauty of the 457 plans, early withdrawals. One other thing I also wanted to state here, right? Let's say you have other plans of your 401k or your IRAs. And if you are bringing that money into a 457, you have to be very careful. Because the IRS can separate those assets. So the money that you're bringing in from other places, that can still trigger the 10% penalty. But the 457 contributions will avoid will not have the 10% penalty. So if you are planning on bringing money over to the 457 plan, be careful. Just know what you are doing. Talk to the professional so that they can help you, guide you right direction.
Wow, that gets pretty complicated. Then you really have to know like where your money is in each of these different buckets then.
That's correct. The reason we are having the conversation just to give that information out there so that when there's a situation, you will think of, hey, Karan and Enrique talked about it, so that I will call my CPA and check on this.
So Karan, we've focused primarily on pre-tax retirement accounts, whether IRA or 401k, whatever. But what about Roth accounts? Because I know that we've seen more and more people invest in Roth IRAs and Roth 401k plans, etc. So how are they different?
That's a great place to start the conversation about Roth because many people love Roth because they understand how it works. Some of the things we'll talk about maybe attract a lot of people because when it comes to Roth, right, you are making the contribution to the Roth account after paying the taxes. Because of that, the potential benefit you receive in retirement, potentially it can become tax-free. That attracts a lot of people. But one thing you want to remember when you are taking money out of a Roth, it comes in a sequence. There's an order of sequence that follows the distributions. The first money comes out of a Roth, we call it your contributions, the money that you put it into a Roth. The second set of distributions will come out from your conversions. That means, let's say you have a conversion from a traditional IRA to a Roth IRA or 401k to Roth IRA. That will be the second layer of your distributions. The third layer will be the earnings. You are taking out the earnings from your Roth. So the first set of distributions is going to be your contributions. Second set is going to be your conversion. And the third set is going to be your earnings, right? But one attractive thing about Roth, the contribution you are making, right, the money that goes into the Roth, you can take out it at any time, at any age, without having you pay any taxes and penalties.
So it doesn't matter, even if you're under 59 and a half, there's no penalty.
Yes, that is the most beautiful thing about Roth.
That is great.
So since we talked about Roth distributions, one thing I also wanted to bring up, the conversions, right? The conversions are a bit different. Each conversion has its own 5 years clock when it comes to penalty purposes. If you withdraw those converted dollars within 5 years, and you are still under 15 and a half, you might get hit with the additional 10% penalty on your withdrawal from the conversion.
So we've talked about, with respect to Roth, we've talked about the contributions and we've talked about the actual conversions, but you mentioned earnings as well.
Right.
So earnings are different?
Earnings from Roth and Enrique, people know that it's usually income tax free, right? But many people don't understand there are some requirements to have that earning treated as a tax-free income. One of the requirements is you need to hold that account for at least 5 years. The account needs to be at least 5 years or older. The second requirement is you need to be at least the age of 15 and a half. This is where the 15 and a half comes back to play, right? And also there are some exceptions to qualify for that 10% penalty here if you are disabled. And there are certain situations you need to meet to get that treatment. But remember, if you don't meet those requirements, your earnings will end up being tax and penalty. So be careful when you are taking the earnings. And if it's a brand new account, pay attention to those details. It might help you.
Yeah, I think that understanding the three different types
Correct.
of monies that are part of the Roth account, it's helpful.
Yes.
So we're talking about Roth. But there's a difference, right, between a Roth IRA and a Roth 401k plan? How do they differ?
So when it comes to the Roth 401k distribution, it has its own 5 years rule. But if you are considering moving money from your Roth 401k to Roth IRA, and the 5 year rules for the Roth IRA will be applied. So it will be depending on your situation. But when you are having a Roth 401k, it doesn't require lifetime withdrawal for the owner of the Roth IRA holder. So that's something it's helpful. And when you're planning for long term, that will certainly be a factor when you are deciding distributions.
So Karan, we've talked a lot about if you actually have to take money out sooner than you planned. But I would think most of us want to keep it in the retirement accounts as long as we can until we have to take it out. So are there rules associated with that?
All this time you've been partnered with IRS. So when you are in partnership, right, you have to give them the share at one point. Right. So when it comes to taking withdrawal from all these retirement accounts, right, at one point the IRS will go like, hey, you are not giving my share. It's time for me to take my share. So what we call required minimum distributions, RMDs. That's what will force you to take distribution out of your retirement accounts. So for someone who was born before 1960, the required minimum distribution age is 73. So if someone who was born after 1960, the required minimum age is going to be age of 75. So just keep in mind that this age and rules can change over the time. Years we are talking about, the age we are talking about based on the current law. So at the time of your retirement, you might as well check in and make sure it is applicable to you.
So the RMDs, do they apply to all retirement accounts?
Almost all of them. Let's go through the list of the accounts subject to RMDs, right? It will include the traditional IRAs, SIP IRAs, traditional 401ks, traditional 403bs plan, and the 457 plans. All are required for RMDs.
Okay, but what about Roth accounts? We were just talking about Roth accounts.
Here's the kicker. The nicest thing about Roth, the required minimum distributions are not required for the Roth. So it can be the Roth IRA or Roth 401k. There's no RMD as long as the person is alive.
That's great.
Also, Enrique, there's one exception to required minimum distributions. Let's say someone is already working and still putting money into a 401k or 403b plan. They don't have to take a required minimum distribution from that plan because they are still working. And it doesn't apply to IRAs or SIP IRAs, right? Or even simple IRA. There will be required minimum distribution, but it's only applicable for someone who is working and putting money into the employer-provided retirement plans. Then there's one other thing you also need to understand. If you are a business owner, and if you own more than 5% of the business, this rule won't be applied to you.
It won't apply.
It won't.
Which means that no matter what, they always have to have a minimum distribution.
That is correct. So sometimes it's become a surprise to the business owner because they'll be like, hey, I'm still working. Why do I have to take income from my 401k? But you are doing well. Also, you are 5% owner of the business. So sorry, you have to take the distributions.
So business owners, no exceptions.
No exceptions. Yeah. Unfortunately, this when you can maybe have some additional planning in place to help you navigate that.
Yeah, they probably need it.
Absolutely.
Karan, we've talked about a special type of annuity that helps delay the RMD, the required minimum distributions. Is that right? Am I
on the right path? It's what we call a qualified longevity annuity contract. It's a provision that you add to an annuity, right? Some people refer to as QLAC. So all that QLAC does is take some of your money from a qualified account where you have never paid the taxes and put it into an annuity. That annuity will help you defer the taxes for the later. So you can defer the taxes as late as your age of 85. So which is a great gift for many people. Like if you are over 70, it might help you reduce your taxable income now because you are deferring that. And also it might be able to provide your income stream for longer in the future, right? So you are also planning for income. And one thing you have to remember, right? There's a limit to it. In 2026, the limit is $210,000 that you can set aside into a QLAC type of annuity. But you also have to remember it changes year to year based on the IRS rules. So if you are doing this, make sure you check with the current rules and what the number is and act on it. But also, this is something you also have to consider with a proper tax planning professional to implement that for you.
It's pretty good, though. I like that. That's a good tool.
Absolutely. It helps a lot of people who may need income later on in life, but they don't want to pay a lot of taxes at this point. So this type of strategy is absolutely beneficial for them.
Excellent. So, Karan, we have some clients that donate quite a lot to charities. Are there any advanced strategies that apply to them?
There is one very helpful tool for many people who are charitable minded. If you are at least age 70 and a half, this is the different age,
70 and a half.
Okay. And you have the opportunity to make a, contribution to your favorite charity up to $100,000. So that $100,000 of contribution to a charity will be considered as your RMD, and it will help you meet that requirement. But one thing you want to make sure when you are doing this, you don't want to cut the check from your personal check. You wanted to make sure the money goes directly from your IRA to your favorite charity. It's different than just, you are writing a check to the charity. So you want to make sure you are doing it in the right way so that you will get the benefit of doing this.
Oh, that makes sense. That's great. Okay, Karan, I'm actually a little confused about something because, most people I know haven't worked for just one company all their lives, right? They've been in different companies and they've had different retirement plans, different IRAs and so on. And we've talked about these required minimum distributions, and they differ by the different types of accounts. So what if you have these different accounts or, many of the same accounts, but in different places? What happens
I hear
then?
you. I can hear you. I can see where the confusion is coming from, right? So you could have multiple IRAs, multiple retirement accounts. So when it comes to IRAs, you can have multiple IRAs as long as, you take the required minimum distributions from one IRA. That may consider that you are taking the distribution from all other IRAs as well. So what we call aggregated IRA distribution, that might help you to satisfy the RMD requirement for your IRAs. But when it comes to 401ks, other retirement accounts, qualified retirement accounts, right, you need to take most likely a withdrawal from each separate account. So that may be a challenge for you.
That's interesting. So IRAs, you might be able to get away with pulling the money out of one account. But when it comes to like your other retirement accounts, like 401k, 403b, whatever, those are different. Those you have to take them out from each one.
Separately, correct.
Got it. So Karan, I'm really glad we had this conversation. As we said in the very beginning, most people focus on the beginning. They focus on, okay, what's the account and what you're going
how to accumulate, how to save money.
You contribute and how much,
how to get up to the mountain.
But nobody ever talks about, okay, so when I retire, what do I do? Like, when do I pull out the money? How do I do it? All these different things. And, what taxes, what penalties apply, all that kind of stuff. So I hope our viewers agree, but I think this was helpful. At least it was for me.
I hope so too. Yeah, before we wrap up, I wanted to leave with your action step for the week. I usually provide an action step so that someone can get benefit from what we discussed. So today's action steps, after listening to us, take 15 minutes of your time and just grab a pen and a paper. Write down if you have retirement accounts, where the retirement account are, whether it is with the current employer or the previous employer or what type of account it is. And then, you write down your date of birth, right? And you write down the age, 15 and a half, 70 and a half, and 73 or 75, because the RMD is different for different people, right? So write down that. And then, start from that. So you will get an idea of what these accounts are and where the required minimum distribution is going to be and what type of tax treatment your account will be, right? So that will help you. But if you need a structured format, we also have a worksheet on our website. If you go to our website, on our show notes for this episode, you can see a worksheet that you can download and complete that. Maybe that will give you a guidance for you to go from here. All right, everybody, that's it for today. I hope this episode was helpful to you. Please share it with anyone who may need a little more financial competence. Please keep the questions and the feedback coming. You can send them directly through our website at Ameriwealthfinancialgroup.com. You can also email us at info@Ameriwealthfinancialgroup with the subject line, question for the talk show. Thank you so much for joining me and
me.
We look forward to having these conversations. And until next time, this is Karan Murugesu and
Enrique Urquillo.
We will see you again soon.